In-depth analysis of the S&P 500 Index, SPX, long-term performance. Last week's performance. As we noted last week, the S&P 500 Index, SPX, concluded with a modest gain of plus 0.24%, as investors maintained their positions in anticipation of positive news from the Federal Reserve in the upcoming weeks. This week's developments. It is quite surprising to witness the S&P 500 transition from trading at record highs to experiencing a minus 4.25% decline in a single week. This situation mirrors the early August sell-off, characterized by strong breadth. While it remains uncertain whether this will result in a rally to new highs, it is noteworthy that the 200-day moving average halted the selling in early August. The conservative S&P 500 strategy aims to shield investors from bear markets, enduring short-term declines without triggering sell signals. Conversely, the aggressive bull and bear report focuses on short-term indicators in greater detail. The conservative approach relies on long-term chart analysis and remains unaffected by emotions or news events. This long-term strategy is designed to tolerate market fluctuations without attempting to time every minor up and down movement. Consequently, we maintain a bullish position in the RIDEX S&P 500 Nova Fund, RYNVX, or other S&P 500 index funds or ETFs, such as SPY. Current S&P 500 Index, SPX, chart analysis. Last week's performance. Last week, the S&P 500 Index, SPX, attempted to break out on Friday, closing with a plus 1.01% gain. However, the actual breakout, if it occurs, is expected to happen in the coming week. This week's developments. This week presents a similar scenario, with the S&P 500 Index, SPX, nearing new highs, only to experience a sudden sell-off. In early August, this was termed a crash, but the early September decline, though equally destructive, lacks a specific label. The SPX was close to achieving new all-time highs, with the NYSE advanced decline line, breadth, at record levels, before the market unexpectedly crashed. This pattern is perplexing and should not persist. Similar to August, investor concerns were triggered by a weak Institute for Supply Management, ISM, manufacturing sector report. Although the news was not entirely negative, any indication that the Federal Reserve might cut rates by less than 0.5% seems to prompt selling. Such reactions could justify a larger rate cut, as Fed Chief Powell aims to avoid a market crash during his tenure. Prominent tech companies like Amazon, minus 3.4%, Alphabet, minus 3.6%, and Meta, minus 2.9%, faced significant losses, along with chipmakers such as Broadcom, minus 9.9%, and Nvidia, minus 5%. The August jobs report, revealing 142,000 new jobs compared to the expected 161,000, further unsettled the market. The critical question for investors is whether the anticipated rate cut, which seems increasingly likely, will alleviate the mounting pressure on certain economic sectors. Following reports of a sharp decline in job openings and dovish comments from Atlanta Fed President Raphael Bostic, the benchmark 10-year yield surpassed the 2-year yield for the first time since June 2022. U.S. businesses generated only 99,000 new jobs in August, marking the smallest increase since 2021, indicating a rapidly cooling labor market. Nayla Richardson, chief economist at ADP, commented, "The job market's downward drift has led to slower than usual hiring after 2 years of robust growth." Economists polled by the Wall Street Journal had forecast a gain of 140,000 jobs. Despite stock sell-offs, breadth remained relatively stable, which is contrary to expectations. This pattern was also observed in early August. Market-moving economic reports released this week. ISM Manufacturing PMI increased to 47.2 in August 2024 from 46.8 in July, below forecasts of 47.5, indicating the fifth consecutive month of declining factory activity. Real Clear Markets/TIP Economic Optimism Index rose by 1.6 points to 46.1 in September 2024, the highest since April 2023, remaining in negative territory for 37 consecutive months. Job openings fell by 237,000 to 7.673 million in July 2024, the lowest since January 2021. Private sector employment. U.S. businesses added 99,000 workers in August 2024, the lowest since January 2021, following a downward revision to 111,000 in July. Unemployment claims dropped by 5,000 to 227,000 for the week ending August 31st, below expectations of 230,000, reaching a new 7-week low. Job cuts. U.S. employers announced 75,891 job cuts in August 2024, the most in 5 months, aligning with other indicators of a softening labor market. Job creation. The U.S. economy created 142,000 jobs in August, exceeding the revised 89,000 in July, but falling short of the expected 160,000. Average hourly earnings increased by 0.4% to $35.21 in August 2024, slightly above forecasts of a 0.3% rise. Conclusion. The current strategy remains bullish on the SPX. Aggressive traders are advised to invest in the RightX Nova S&P 500 fund, RYNVX, or other bullish S&P 500 index funds or ETFs, such as SPY.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.